The US stock market has gone up by more than 40% since the March 23 lows, while the economy is still in dire straits and the coronavirus continues to infect tens of thousands of people around the world. Is the US stock market overpriced? Is it time to sell? In this video, I'm going to give you a case that argues that the US stock market is overpriced, and I'm also going to give you a case that will argue that the US stock market is not overpriced, and I'll let you decide. Keep in mind though that there are other stocks or companies that are listed in Europe, in Asia. So in this video, we're going to focus specifically on the US stock market. I'm going to share two indicators that will show that the US stock market is overpriced. The first one is the total stock market to GDP ratio. Sounds really technical, but basically the US economy can be fairly represented by the gross domestic product, or more properly known as GDP. And the US stock market is basically the total stock market. So in general, if you think about it, most companies are publicly listed, but some are private. So one can argue that the stock market is probably going to be worth just below the GDP. So typically it might hover around 90% of GDP. So if we take a look at the graph that indicates the ratio of the total stock market to US GDP over time, we can see that in the 1980s, it hovered around 50 or slightly below 50%, started increasing in the 1990s to 60, 70%, shot up right before the dot-com bust of 2000. It was worth, I think, around 125% according to this graph, and gone back down again since then, dropped precipitously during the 2008 recession all the way down to below 60%, which was back then was really a bargain. So guess where we're at right now? The total US stock market to GDP ratio is at 177%. What that means is investors are valuing the US stock market at 177% of the US economy. And that's a case for the US stock market being overvalued. The second indicator that argues the same way is CAPE, not the Batman cape, but the cyclically adjusted price to earnings ratio, which is another super technical term. If you want to learn more about the details of this so-called price to earnings ratio, make sure you watch our video on how to select stocks, where I go into the deep dive of what this means. But essentially, this ratio is a number, and the theory behind it is, on the average, this price to earnings ratio hovers around 16. There's a theory in finance that says sometimes it would go above that number, sometimes it's below that number, but regardless, it always goes back to the mean. We don't know how long and over what time period, but it goes back to its mean. But guess where we're at right now in terms of this CAPE ratio, or price to earnings ratio. The average is 16. Right now, we're close to double the average. So the price to earnings ratio, cyclically adjusted right now, is at 31. Another indicator that is arguing that the US stock market might be overvalued. If you're kind of a nerd like me and wanna do a deep dive into all the math behind whether or not the US stock market is overvalued, I strongly suggest you read this article by a multi-billion-dollar investment advisory firm called GMO, whose co-founder is Jeremy Grantham, famous within the investment community. In 2017, they wrote an article entitled "The S&P 500 Just Say No." And I'm gonna post a link of that article in the description of this video. On the flip side, I'm gonna give you three indicators that says, maybe the US stock market is actually not overpriced. So first indicator is interest rates. So interest rates are so low compared to back in the 1990s or 80s. I was just looking at the chart. In the early 80s, interest rates were above 15%, if you think about that. That's crazy. And right now, the 10-year Treasury note is yielding at 0.64%. It's like a fraction of what it was before. Now, what does this mean? If you Do the math. There's a formula. There's a thing in finance that's called the discounted cash flow analysis, where if you want to compute the value of a stock, you basically compute all its future cash flows and lump it all in one number. And the denominator of this is the interest rate. So if you think about it, if you have a very low denominator, like 0.64, the value of that is going to be really high. And that's what's happening right now. Because of the low interest rates, it is justifying high stock market prices, especially for growth stocks. Now, Morningstar, if you have access to their subscription, actually computes the value of companies based on a number of things, including discounted cash flow analysis. And if we look at the US stock market represented by the S&P 500, we look at the top 10 holdings of that. According to Morningstar, actually only 3 of the top 10 holdings of the S&P 500 are overvalued. So that's another case that the US stock market might actually not be overvalued. Lastly, another indicator is comparing bond yields, which is what you get, like the dividend yields when you buy a bond fund, compared to a ratio called the US stock earnings yield, which is what you essentially get, sort of. It's another technical term, which is the inverse of price to earnings ratio. Lastly, we can also compare the bond yields and the US stock market earnings yield. And I'm not going to go into detail on how those formulas are computed, but essentially, because bonds are more stable, the expected return is lower, and stocks are more volatile, the expected return is higher. So you would expect on a normal scenario bond yields to be lower and stock earnings yield to be higher. And typically it's that case, except for late 1990s, where tech stocks especially was just rising and rising, and at some point in time bond yields actually equaled or was more than the stock earnings yield. So that indicated that the US stock market back then was overpriced, because if you think about it, bonds are supposed to be more stable, and now you can actually make more money by investing in bonds, so something wasn't right. So right now bond yields are about roughly 2%, and US stock market earnings yield is around 3.2%. Bond yields are still lower, so that's another argument that says the US stock market might not be overpriced. So there is it, my friends, the case and the counter case on why the US stock market may or may not be overpriced. But really, the better question is, are you focusing on the things that you can control? Such as, are you investing in low-fee funds? Do you have a rebalancing program in place for your 401k and IRA? Are you using tax-efficient retirement vehicles like a Roth IRA or a backdoor Roth IRA that can enable you to grow your money tax-free? So I suggest you spend more time asking those questions. But I am interested in hearing what you think, so do let me know what you think. Is the US stock market overvalued or not overvalued at this point in time? And I'm also interested in hearing what questions related to investing you think are more smarter or more valuable to ask in these day and age. And I'm also interested in hearing from you, what kind of questions should we actually be asking in relation to the stock market? Until next time.